Good morning, everybody. My name is Drew Addison, the Vice President of Surety at IBTX. Thank you so much for joining me today for the data-driven Surety session of the Virtual Construction Conference brought to you by the Maestro Entrepreneur Center. I'm so excited to speak with you today. I believe that it'd be pretty hard pressed to find somebody that is excited as I am about surety bonding, and I'm sure that you're going to be excited about it too when it's all said and done. There's a lot to cover. If you do have any questions throughout the process, I do recommend you dropping the questions, and we are keeping track of those. So as they come in at the end of the presentation, I'll try to address as many as I can before they move on to the next session. But don't feel bad if I don't get to them. We are collecting the questions anyway, and I will be able to address them offline as well. And I can maybe contact you directly on the Hoover app that is set by the Maestro Entrepreneur Center as well. But as mentioned, this is the data-driven surety session. And I know, again, like I mentioned, that we have very little time on a lot of this stuff. So I'm going to really kind of do a quick overview of what is surety and why is there surety in a 3-minute overview. I always say it's a 3-minute overview. Normally it takes a little bit longer than that, but I just kind of want to make sure everybody's on the same page on exactly what it is that we're covering, and then where we take it from, pulling your file in, your information, getting the program placed, getting you the best options that are available, and getting you off and running into bonded work. So what is a surety bond? A surety bond is basically an agreement that is put together that really attaches to a contract, and there's really two sides of surety. There's the contract surety side and there's the commercial surety side. Majority of what we're talking about today is on the contract surety side when it comes to construction. So that's your bid bonds, your payment bonds, your performance bonds, maintenance and supply bonds. And then on the commercial side, that's your license and permit bonds, right-of-way bonds, things that are required by the city, the state. There's literally thousands of them. So obviously we only got 30 minutes today, so we're not going to dive too deep into those. But the basic structure of a surety bond is it's a 3-party agreement, and like I mentioned, it attaches to a contract. So there's the principal, which would be the contractor in this case. There's the obligee, who's the owner of the project or the general contractor, and then there's the surety. So that's really the biggest difference between surety and insurance, right? So an insurance is a 2-party agreement. A surety bond is a 3-party agreement. And why are these bonds required? So there's 2 basic functions of surety bonds. There's the pre-qualification side. So basically, a contractor that goes through the process, gets a program in place, goes through an underwriting process in which we will be talking about. But through that underwriting process, we're basically pre-qualifying the contractor. And so we want to know about the experience, the knowledge, what the financial resources are to make sure that you are profitable and are able to take on this work. They also serve as financial protection, and it protects the owner and protects the owner or the general contractor surety from the default of the contractor, who is the principal of those bonds. It guarantees the projects that will be performed according to the contract, and all entities under the contract, under the bonded contractor, will be paid, such as your subcontractors, first, second, and third tier subs, suppliers, everybody else that's on there. What is extremely important, and what's in yellow down there, and I want you to note that surety bonds are not insurance policies. Surety bonds are not put in place to protect you as a contractor who's required to post them. They're there to protect the contractor, or protect the owner of the project or the GC surety who is requiring them. So, a lot of times you may jump into a contract where the general contractor is asking the subcontractors to bond back to them. But majority of the time, that's not the GC's call. GC typically has to pay for those premiums, so they would prefer most of the time not to have to do that. Normally, that comes down from the GC surety requiring those. And also, when it comes to public work, depending on what contract size that you're in, you reach these different thresholds of what the bonding requirement is going to be. So maybe the city or the state is going to sit down and they're going to require you as the contractor to bond to them, right? So, and what I mean by bond to them is they want the protection that you are going to perform the work based on what the contract says, and that everyone is going to get paid along the way. So why we can take a deeper dive into why they're required from a legislative standpoint. So from a federal level, it started with the Hurd Act in 1894. And later kind of grew into the Miller Act of 1935. So the Miller Act kind of expanded on what the requirements were going to be on when bonds are going to be required. So basically, it requires performance and payment bonds on projects in excess of 150,000 on federal work, and then payment protection, meaning payment bond only for contracts between 30,000 and 150,000. So basically, what you can look at is when you're approaching federal work, any contract that's over 30,000, you're gonna have to have some sort of surety guarantee to protect that. From 30,000 to 150,000, payment bond only. Anything over 150,000 is going to require payment performance bonds. Now, on a state level, and every state's a little bit different, so there's little Miller Acts. And so in the state of Texas, I have it listed here. So any project, just like on how the Miller Act states for the federal work, for projects that are state funded between 25,000 and 100,000 requires payment bond only, and projects over $100,000 is payment and performance bonds, right? So again, put that in your head that, you know, if you're going to approach state funded work, any project that starts at $25,000 or more is going to require some sort of surety bond protection. Now we can move into the city of San Antonio, right? So it's even a littler Miller Act, I guess you can say. So the city of San Antonio, I know there's going to be some presentations from the city of San Antonio, and then maybe some general contractors that are doing work for the city of San Antonio. This is a really important slide for those that are looking to get into city work, whether you're going in as a prime or even a subcontractor. So in this case, you know, anything greater than $100,000, this the littler Miller Act for City of San Antonio will require payment and performance bonds of 100% of the contract sum. And then any contract that is $50,000 but less or equal to $100,000 is payment bond only. So again, put in your head that with the City of San Antonio, any contract that you enter into that's $50,000 or more is going to require some sort of surety protection. Now, in the case that there is a contract that is less or equal to $25,000, there is technically no requirement of the contractor to provide payment or performance bonds for the City of San Antonio. But what's key here is how the money is going to be paid out for that contract. So in this case, no money shall be paid by the city to the contractor until final completion of work, assuming that you do not provide performance bonds, or in this case, payment bonds. If you do post the bonds, if you do post the bonds, the contract sum shall be payable to the contractor through progress payments. So what does that mean for you as a contractor? If you are spending money for supplies or mobilization, you have this upfront cost, and you know you're not sure when that money could be coming through, and this is a smaller contract. It may not be a bad idea to look into posting the bond to the City of San Antonio in order to really engage those progress payments to help you pay for those deals. So all this is really extremely important to take note of. So imagine you being a contractor, and I'm sure there's a lot of you out there that only do private work. So there's no mandate for the use of bonds on private work, right? So it's not like Little Miller Acts or anything else where you're doing federal or state or city work. This is really discretionary. So private owners could require contract surety bonds for the really same reason why the government of the state does. You know, they want to make sure the contractor is qualified. They want to make sure the project is completed according to the contract and make sure that everybody gets paid, right? There's also other private works bonding requirements, sometimes coming from the prime contractors. And it's, again, for the same reasons that the government of the state does. They want to make sure that everybody is qualified and that there's not going to be any sort of payment issues going along the way. And then also banks and commercial development lenders also, I'm seeing it more and more where they're starting to require the bonds as well. So, you know, a lot of times they'll put it as a condition of financing. So, you know, you'll have a developer that is looking to develop this plot of land. You're going to come in and contract directly with the developer. But in order for the developer to get that financing, all the contractors listed on their project need to provide some sort of payment and performance bond protection in order for that financing to go through. So, and a lot of times when you go into underwriting for private work, the underwriter will request maybe some information on where the financing is going to come from. And this is some additional verification there, but just be ready that that requirement for payment performance bonds could come down. So 3 minutes, well, I guess here we are 9 minutes in on a 3-minute segment of an overview of surety bonds. I know that was a lot. But I really do kind of want to dive into what the underwriting what takes place in that case, right? So I actually borrowed some of these slides from an underwriter that I work with named Victor Ruiz from Markel Surety. We recently did a presentation to the Hispanic Contractors Association in San Antonio. He had some really great slides when it came to the underwriting side. I figured it was a really great opportunity to share with you guys as well. A lot of times in these surety presentations or the lunch and learns, you'll hear the 3 C's of surety: character, capital, and capacity. And there's also the additional 2 C's: continuity and contracts. So these are very important, right? So, and I always say this is kind of falls into the gray lines of underwriting. So not so much capital and capacity, but the character side is extremely important. So it's not just that are being reviewed. It is, what you do, what's your experience, and how do you run your business? What are the processes? What are your key employees? What is their experience? All of that is considered. When it comes to continuity, you as a business owner, if we have a program in place, they want to know that if, God forbid, anything happens, there is a continuity plan, right? And God, again, dives into the key employees, dives into an actual formal plan of continuity. What is your life insurance policies? And then we dive into contracts. So, we set up a surety program. You have a bond request comes in, a contract comes in. We're basically going through that thing with a fine-tooth comb. And I know sometimes it can be a lot to consider. And it's like, man, maybe what's taking so long? It's ultimately to protect you, because again, these bonds are not to protect the contractor; they're to protect the owner or the GC surety that is requiring these bonds. So we want to make sure that you are protected along the way. So when it comes to the financial information that is requested, right? So, and there's actually going to be a really great session tomorrow morning. I believe it's at 9:45 from Adam Schlepper from CLA. It's a CPA firm. He's a construction CPA. Highly recommend you guys attend that session as well. But when it comes to company financials, we want to look at obviously your fiscal year end financials and your interims, meaning your quarterly financials. So quarterly updates is extremely important. And when it comes to your in-house financials, must be on accrual basis. So take note of that. So sending us a cash basis statement is not going to help. We're basically going to ask you to go ahead and get it switched over to accrual basis. Personal financial statements are really important. We do have templates that you can use, but you can actually reach out to your bank or your CPA that can actually put together a detailed personal financial statement. And coming from a third party is always a little bit better than filling it out yourself. Again, third party verification is extremely important in this process. And now we dive into work in progress reports. Or work on hands. It's extremely important to take some time, do some research on percentage of completion basis WIPs, right? We do have a template available. If you guys need one, reach out, let me know. It's a percentage of completion WIP that actually auto calculates everything for you. But make sure you understand what it is that you're looking at. Take some time, do some research on what percentage of completion basis WIP analysis is. All that is extremely important, especially when it comes to the underwriting side of things. And then it's also really important on how you run your business, how you run your projects. A percentage of completion WIP tells a lot about how your projects are performing and what your processes are doing along the way. And lastly, a bank letter and especially a line of credit. I know that right now it's probably not the easiest time to go to your bank and ask for a line of credit or even ask for an increase. But it's important to start working on it now, because that is a relationship game just as much as surety is. That line of credit is really important. It's not, the surety's not going to look at it as like an asset or a working capital, but it's a box to check. That is a very important box to check, because look, if you get to the point where you're thin on capital and you really need to dive into that line of credit to keep things moving, that is what that is there for. Now, hopefully you're not put in that position where you need to do that, but it's always a just in case good thing to fall on. When you establish that line of credit, it's important to run that line of credit just like you run your credit cards, right? So you want to utilize that line of credit, even if it's just a little bit. You start a project, you buy some material on your line of credit, you get the material out to your project, you submit the pay app, you pay your line of credit back, and you're just working it like that, right? So spend some time with your banker, understand what it is that you can do to establish a line of credit and to build on that. It's so important. So the financial statements, and I mentioned that Adam Schlepper is going to be presenting tomorrow morning. Their CPA statements are extremely important when it comes to surety, right? So there's 3 different types of statements, and Adam will go into more detail on that tomorrow. There's the audit, review, and compilation. Compilation is a good place to start. There's nothing wrong with it. But there's different levels of verification involved with these different types of statements. So it starts with compilation, which is not much verification. They just kind of make sure things are reporting the way they need to do. Review, there is a level of a good enough level of verification that for surety, your typical standard surety program, reviewed statements is just fine. An audit is typically required by like TxDOT or large programs, to where, you know, once you become so many processes in place where an audit makes sense, then sometimes that would be required by the surety. But your goal is to get to a reviewed statement as soon as you can, not just for your surety program, but just for your business. And it helps with the line of credit too, helps with your banks. And you know, they would appreciate it, and it's just good reporting all around. When it comes to in-house statements, quality is very, very important. Your balance sheet, income statement, AR and AP, and your percentage of completion work on hand statement, focus on those. Most CPA firms do offer some sort of consulting where they can come in and kind of clean up your financials to start reporting on a percentage of completion basis, and to make sure that it's reporting correctly. If you're unsure on how to set that up, please reach out. We do have some great opportunities, especially for the Maestro Entrepreneur Center contractors that are involved, for discounted rates. So please reach out, let me know, we can get you connected. And then, you know, if we're only starting the surety program on in-house statements only, verification is key. So if you were to submit to me only in-house statements, more than likely I'm gonna have to come back and we're gonna have to do some additional verification of bank accounts, right? So a lot of times, sometimes that'll be bank statements. They want to make sure that the cash, maybe the cash that you have on your balance sheet, is reflected what's actually in your bank account at the time. So that's just an example of what that verification is. So be prepared for that. So financial statement basics. You know, when we start doing the underwriting, we're going to be taking a look at where the cash is going, you know, in and out. And we have at IBTX, we have a program that allows us to really kind of, and we can give it, we provide the report to our clients, but we really want to see where the cash is going from when it enters the company to when it leaves, and seeing if there's any sort of processes that we can create to make it more effective. Again, work in progress reports. What is the profitability of your job? Is there any profit fade? And then we want to, and the difference between backlog and cost to complete when the underwriting, most surety companies are backlog based, means your entire backlog is considered on the aggregate level. But there are programs set aside for cost to complete. So it's very important that you, if you do have a surety program in place, make sure you understand whether you're on a backlog or cost to complete basis, because that's, you know, that's a capacity question that could serve you very well in the long run, and really how to manage all that. So additional information needs. So the more information that we have is the better, it provides a better outcome at the end of the day, right? So you know, we want to get to what's your org chart of your company? What are the key employee resumes? Do you have a business plan? Business plan. I'm going to say that again on the next slide. Are there any related companies? We've talked about continuity plans. What subs are you using? Do you have recommendations from project owners? All of that comes into play. We want to collect as much information as we can and tell the best story for you when we're going out to market for a surety program. Or if you have a surety program in place, you know, it's important that your underwriter knows all this stuff too, right? So you may be, if all this is not submitted to your underwriter already, you may be selling yourself short. You know, you want to provide the best information possible, and it's up to your agent to really kind of sift through all the information and put it together in the best package to provide the best opportunity for you. When it comes to the underwriting considerations, continued here, the underlying agreement, this is the contract. So, you know, if a lot of times I live in a world where a bond is needed like yesterday. So the contract comes to me, we need to get a bond put together. So we go through that really quick, right? We need to understand, you know, what is involved in that contract and how are the bonds going to relate to it. Do you have sound financials? Do you have committed and competent personnel? Do you have a business plan? And I'm not saying this is the end all be all for surety programs, that if you don't have a business plan, it's not going to happen. It just increases your odds. And then what is the personal and corporate indemnification? I'm going to get into that right here. So indemnification is very, very important. So when we enter into a surety program, the surety company is going to offer up a contract called a general indemnification agreement. This is very similar to a bank loan agreement. And what it does is it grants specific rights and authority to the surety, right? So, and it is so important for you to understand and read this agreement completely, right? So Texas is a homestead state, and with a indemnity agreement, a majority of the time your personal indemnification is on the table, and that's common. That is the status quo for where a surety program starts. So what that means is, with Texas being a homestead state, that your home is safe, your 401k is safe, but everything else is on the table for liquidation. So if there's a default, the surety company is going to go after the company's financials, and if there's not enough there, they'll want to recoup out of your personal financials. So make sure you're very aware of what this thing says, right? So there's different levels of surety programs. It starts really with the quick application, and this is, I normally pull this trigger in an emergency situation where it's a small contract, they need it like yesterday. This is based solely on personal credit score of the owner, right? So it's a average minimum score of 650. The program capacity size are pretty limited, right? So we're talking about like a $300,000 single, $500,000 aggregate. There's some programs coming out there that are a little bit larger, but we want to make sure that it fits, and it's not a long-term solution. This is something that we can get it done real quick and get you the surety coverage that you need to move forward. There's still a general indemnification agreement involved with this, so keep that in mind. There's typically also a higher premium on average for this. So the average for that is 3% flat average, right? So if you're calling and you need a bond like yesterday, we need to go with a quick application, you expect a 3% flat average rate, right? So if you're going into your estimations, you don't have a surety program in place, and chances are you may need one, that's probably a good number to start when you're adding it to your estimates. And then there's also project scope limitations. So these are pretty reserved for very simple scopes, anything complex, like abatement, things like that, off limits for quick application. We have to go more of a standard route. But again, no financials needed to get this thing going. It's a one-page application, goes off your personal credit score. And then there's the transitionary program. So this is kind of like a hybrid between quick application and standard program, where it's very personal credit score driven. The premium rates can go down a little bit, but not really a whole lot, because there's just not a whole lot of information there. And it really kind of kicks off with in-house statements. So if you only have in-house financial statements, we probably won't be able to get standard premiums until we get you moved over into a CPA, getting a CPA statement, unless there's a decent enough amount of capital and you have the experience and everything else. We want to make sure we do a full underwriting there. You have to be prepared in these cases for the surety to require some sort of collateral requirement or funds disbursements requirement. And that's funds disbursement is commonly referred to as FDS. And that's basically a third party controlling the payments from the owner, and then they cut the checks to your suppliers and your subcontractors and you at the end with the profit directly. So you have really no control over where the money goes. Money goes from the owner to the FDS company wired directly. And then from there, the checks are cut, right? So you have to really kind of have your head ready and the process is ready. And it's something you really need to talk to your surety agent about. And I do request that, if you do have something that's coming along the line, or if there's a possibility, to please, give your agent some time to kind of digest some of the information and get you the best option available. One thing to consider too, these programs are a little bit slower in development. So, if you're looking for a boosting capacity, something we can negotiate higher capacities for you than what's on the quick application. So you might be able to go after slightly larger work. But if you're looking to go after larger work sooner, it's probably going to happen a lot slower. So again, get with a good construction CPA. Your tax CPA is not going to be able to help you here. You need a construction CPA. Tomorrow, Adam Schlepper, CLA, presenting at 9:45, I believe. So check it out. And then we move into standard programs. I get asked all the time. So Texas is a standardized premium state, meaning that, depending on the scope of work that you do, the premium rate is set. Like there's no cheaper premium. So whether you're, a startup GC or a GC that's just rolling onto a standard program, your premium is going to be charged just as much as that giant GC that you did work for just last year, right? So it costs the same for everybody. Now, what's important to keep in mind is that we have all the processes, all the information, everything in place. You are already engaged, that you're at least engaged with the construction CPA to get some sort of a fiscal year-end statement. You're providing quarterly updates. We have all the information filled out. We spent some time, we got the program set, standard programs, right? So the classes depend, the premium class is dependent on what scope that you do. So for each one of these, I have a scope example. So for class A1, it's the lowest rates that we have. Here's some scope examples: flooring, fire alarm systems, conveyors, signs, sidewalks. Premium rates start at 9.4%. All these premium rates are structured. So the larger the contract, the smaller the premium rate. So when you call and ask me what is my premium rate percentage, and you see that a lot on pre-qualifications, like it depends on the size of the contract and how long the contract's going to be. So this is the structure for each one of the classes, right? So again, these are scope samples. The scopes, the actual scope lists are quite a bit longer, but these rates fall into pretty much everybody that should be listening in this case. But class A1 being the lowest rates, it starts at 0.94% of the contract amount. Class A, so this is highways, roads, street paving, ceilings, curbing, cabinetry, roofing, starts at 1.5%. Again, larger the contract, the smaller that percentage. Class B rates, this is general construction. This is masonry, drywall, excavation, painting. The a little bit higher premium rate. Then the reason why they're accepting more risk, right? So that's one way to think about it. So these premiums start at 2.5% and then get smaller from there. And then, like I mentioned earlier, some of the requirements where it's payment bond only. The class rates for those are, since we're only providing the payment bonds, is 0.975%. So this would kind of fall in line with the smaller contracts that you're looking for. Talking about some additional underwriting tools that I'd mentioned before. Look into SBA, look into the mentor protege program with the city of San Antonio. Familiarize yourself with funds disbursement and collateral. How does that work? Ask your agent for help on all this. So what we do internally at IBTX is we actually underwrite the files directly. Not only are we doing it from an underwriting perspective, but we want to get you connected into the network as much as we can. So whether that be through CPA connections, legal connections, banking connections, we also have some other bells and whistles that we can kind of get you connected in with. And even some of the general contractors and subcontractors that we work with, we want to make sure that everybody's working together and getting things done. From a analysis perspective, we do trend analysis year over year, work on hand analysis, deferred ratio analysis, and I'm going to do a quick explanation of what that is since I have 3 minutes left. We do benchmarking with companies, what's your break-even number of contribution margins, we do forecasting, all of that. What do I mean by deferred current assets? This is part of the underwriting process. Familiarize yourself with this. This slide deck will be available, so make sure you download it. If you have any questions, please feel free to reach out to me. But this is a list of current assets that your surety underwriter is going to defer out as not current. So we do that first, and then we run our analysis so we can see what is happening within your company. We can show you what's happening within your company. Though when it comes to the working capital, analyzed working capital number, working capital is the lifeblood of your surety program. That's current assets minus current liabilities, but it's current assets minus these, right? So we got to make sure we understand where we fall in your program on that and do the negotiations for you. The equity point. So that's really important as well. So those are the two main veins and lifebloods of your surety program. So keep that in mind. If you have any questions about where you fall, please let me know. We recently kind of kicked everything off and put it into put our program on steroids a little bit, added some multiple regression modeling. This allows us to see, analyze each portion of your financials to see what actually drives it. Good information for you as a business owner and good management tool. So if you'd like some more information, please reach out. Economic performance, your financials based on the performance of the economy. All that's very important, especially when it comes to city and state work, where maybe the economy has a driving factor on what your company performance is going to be. Revenue backlog forecasting, all this is available to you. I do have this final list here. I know that we're running short on time, but this is the list of all the information you need to submit for a full file. So please, any questions, this is my contact information. You can call that number, get me directly, shoot me an email, find me on LinkedIn, find me on Instagram, check out the Ahead of the Game Construction podcast. Me and a buddy of mine, we have been doing that lately. So if you have any additional information on what these guys are doing, reach out, let me know, be glad to help. But thank you so much for joining me. I really appreciate it. Leslie's waiting in the limbs here, ready to help in any way that she can. If you have anything, any questions, anything, please reach out. I really do appreciate it. And I guess we have a couple minutes. I don't know if there's any questions. Okay, yeah, I think we're good. Awesome. Send your questions directly to me and we'll be ready to go. Thank you so much and we'll talk soon.
Thank you, Drew. If you do have any questions, we're going to be opening a community topic on Drew's presentation. And so feel free to join on there and ask any questions, and we'll see you next session.
Awesome. Thank you.
Thank you, Drew.